Okay, so we're going to continue on with our discussion, and we have some kind of basic definitions here. On our slide here, we have 4 different types of inventory cost flow assumptions. We have this specific identification method. We're not really going to look at that. That's for very expensive items such as cars that have a VIN number. Jewelry and so on. Guns would be another example. We're going to focus our attention here on these 3 methods, the first in, first out, last in, first out, and the weighted average method. And most of what we're going to look at between those 3 is going to center on first in, first out, and LIFO methods. Okay? And we have a definition here. We talked about this on the previous slide, but it says for FIFO, the first units purchased are assumed to be sold, okay, and the ending inventory is made up of the most recent purchases. LIFO is the exact opposite. The last units purchased are assumed to be sold, and the ending inventory is made up of the first purchases. And then finally, weighted average, sometimes called average cost. Cost of the units sold and an ending inventory is a weighted average of the purchase cost. So weighted average, if we buy 3 items and one item we pay $8 for, and then I don't know, let's say 3 items we pay $10 a piece for, well, that would be $38. And then I said we bought 4 of them, so our weighted average cost would be $9.50. With first in, first out, we're going to expense that $8 item first. Last in, first out, we're going to expense that $10 item first. Weighted average, we're going to use the average of whatever it is we've purchased. Usually used with a periodic inventory system, though that is not required. Okay. So what we have here is a summary. We've already looked at this, at least similar information. We were given a few slides back, we looked at an example of a product that was being sold for $20, and we had 3 items purchased at different times. One was purchased for $9, one for $14, and then I believe there was another one that was purchased for $13. And so what we have here, and I kind of got into this at least with regard to FIFO and LIFO on the previous slide, but you have an example of how that would all work out in terms of both cost of goods sold and gross profit, plus also ending inventory over on the balance sheet. And then also we can see how it would work with weighted average cost. We had the 3 items totaling $36 divided by 3 gives us an average cost of $12 a piece. So you can see the cost of goods sold becomes $12. Gross profit is based upon that. Our inventory is just going to be 2 times that same $12. So some slight differences in all of these. All of these methods are going to usually result in different answers for cost of goods sold and gross profit, as well as inventory. The only time that these methods will not result in different answers would be if prices are completely stable, and that does not normally happen. Okay, so let's see here. Using a perpetual system, we've got some data for an item. We're just going to call this item 127B. And what we are looking at here, it doesn't tell us that we're using the FIFO inventory method, LIFO method, weighted average. It doesn't tell us any of that stuff. What it does tell us is that we have a beginning inventory of 1,000 units at a $20 cost each. And then we have several transactions here. Looks like 1, 2, 3 sales, and then we also have 2 additional purchases of inventory. Do notice that both the quantity purchased is different, 500 and 600, and then the price paid is different as well. So it looks like prices are going up for this inventory item. This is a pretty good jump in price over the course of just 1 month, but we have to give you an example. And so this would be considered a period of rising prices. So these are just the facts. And what I want to tell you right now is that we can take this set of facts here and we can calculate using FIFO, LIFO. We can even calculate using weighted average. We're going to start with the FIFO method. We've discussed a lot of this. FIFO tends to have what is referred to as a balance sheet advantage. It says, it gives you the definition of it up here. It says when it's used in a perpetual inventory system, costs are included in the cost of goods sold in the order in which they were purchased. This is actually true whether it's a perpetual inventory system or periodic. It doesn't matter. You're going to get the same results with the FIFO method. It says this is often the same as the physical flow of goods. I don't know how much I agree with that, but they do give a good example here. It says grocery stores shelve milk and other perishable items by expiration date. So for the most part, it does work out well with perishable type items, though not always. And then LIFO. LIFO is a little bit different. Your results with LIFO are going to change whether we're talking about a perpetual inventory system or a periodic system. It says LIFO method was originally used in those rare circumstances where the units sold were taken from the most recently purchased units. However, for tax purposes, LIFO is now widely used even when it does not represent the physical flow of units. So there are some situations where where we're going to use LIFO and it will match up the physical flow of goods. The best example I can give you is, if we're talking about a hardware store, for example, you got these big bins of nuts and bolts. Each bin will hold 1,000 of whatever it is, and you just buy those. People come in, they buy them a few at a time, and then when we go from 1,000 eventually down to say 300, maybe we add 200 more. Well, guess what? Those items on the bottom may never sell. So in that one rare situation, we would have a situation where LIFO matches the physical flow of goods. Usually it does not. Why do they say that it's used for income tax purposes? The reason is if we think about that slide where we saw the prices are continuously going up, well, if we use the LIFO method, we're costing the most expensive items, the most recent items in a period of rising prices. That's going to decrease our profit, at least on paper, okay? And we're going to pay less income taxes. Now, if the price of the goods goes up, we don't have any kind of income tax advantage, but that's what they're talking about here. All right, we've got some examples. These are, if you're in a class with me, in your ebook, we have these checkup corner things. If you're not in a class with me, or if you have a hard time finding it, give you a second and you can screenshot this. This will provide you with some really good practice because it's asking you to come up with cost of goods sold and ending inventory as of the January 31st end of month for both the FIFO and LIFO method. So go ahead and screenshot that. And then in our next slide, we have the solution, and you will most definitely need to screenshot that because we would not be able to go through this under any normal circumstances. It's just too much information. Okay, and then let's talk just briefly. Go ahead, we're going to move to the next slide now about the weighted average cost method. It says the weighted average cost method is used in it says when it's used, a weighted average unit cost for each item is computed each time a purchase is made. This unit cost is used to determine the cost of each sale until another purchase is made and a new average is computed. This technique is called a moving average. I have seen language in textbooks before that indicates that the weighted average method does not go well with the perpetual inventory system. And that's not true. It's just that whenever you're talking about a retail environment, for example, you have to have, where you're dealing with a lot of transactions, sales transactions, a ton of purchase transactions, you'll need a computer point of sale system and inventory tracking system to do that math for us. We don't do a ton of calculations in a school setting using the weighted average cost method, because it can get fairly difficult if we have any number of transactions whatsoever. But when I was in business, for example, I used the weighted average cost. Okay, let's go ahead and close this video out, and then we'll get started on further discussion of periodic inventory systems next.